The debt owed to Nigerian banks by oil and gas operators as well as power companies have risen above 6 trillion naira. Well, this is according to the latest data obtained from the Central Bank of Nigeria. The energy firms increased their bank debts to 6.14 trillion naira as of June 2021 from 5.94 trillion naira at the end of 2020. According to the sectoral analysis of banks' credit by the CBN, the 6.14 trillion naira represents 8.05% of the 21.89 trillion naira loan advanced to the private sector by the banks as of June 2021. Oil and gas firms, which received the biggest shares of credit from the banks, increased their debt by 140 billion naira to 5.32 trillion naira by June 2021 from 5.18 trillion naira in December 2020. The CBN data also shows that debt owed by power firms to the banks rose to 823.2 billion naira in June 2021 from 763.2 billion naira in December 2020. And in other news, the Nigerian Communications Commission has proposed a fine of 200,000 naira for mobile communication services providers that fail to verify and validate biometric, national identity number, and other personal information of each subscriber to their services. Well, this was contained in the proposed draft regulation on registration of telephone subscribers 2020, recently published on the NCC's website. According to the regulation, mobile services are providers that allow subscribers to make and receive calls, send and receive short messages services, and other range of services usually provided by such operators without first verifying the subscriber's personal information, including NIN, will be fined per subscription medium. Well, let's go to the discussion as we start at Nigeria's gross domestic product recorded a growth of 5.01% in the second quarter of 2021, making 3 consecutive quarters of growth since the last recession. Well, this recent growth level is imminent due to the steady recovery observed since the end of 2020, with a gradual return of commercial activities. But despite the positive growth rate in the country's GDP, over 7 million Nigerians lost their jobs due to inflationary pressure in 2020, taking the total number of poor people in the country to more than 83 million. That's about 40% of the total population. Although the country's inflation may now be growing at a slower pace amidst the third wave of COVID-19 pandemic, the combination of rising inflation and unemployment rates create a unique set of challenges for policymakers. Policies that boost economic output, reduce unemployment, such as a reduction in taxes, increase in government spending, would worsen inflation because these policies tend to increase the supply of money in the economy. Indeed, let's break this down. And I have the right person in the house to do this. He's the Chief Investment Officer at Afri-Invest West Africa, Mr. Robert Omotunde. It's good to see you this Monday, Mr. Omotunde.
It's my pleasure to be here again.
Like I asked you before we came on set, is there a recovery somewhere? What is happening? 5.01% growth is what we've seen. And we've also seen the steady decline with regards to inflation, which, according to the monetary side and the fiscal side, they are saying, well, this is the way to go. We are growing positively. But deep down, Nigerians are saying, we're seeing these figures, but it's yet to impact on us, put food on our tables. Can you explain this to us?
Yes, rightfully so. You know, Nigerians or the masses have the right to begin to look at how, impactful macroeconomic data are on their well-being. And I mean, we call it data, right? But most times we forget that these data are talking about human beings or the condition of living of the people, right? It's true that, yes, as at Q2, we recorded 5.01% growth in the domestic GDP. But again, we need to be able to dissect this growth for us to be able to contextualize what exactly it means. Do not forget that in Q2 of 2020, the economy contracted by about 6.1%.
Yes.
Now, that base effect factor, economists call it base effect. Base effect simply means that the economy was coming from a certain level and then dipped that much by 6.1%, which was about the biggest form of drop we have seen in almost almost 2 decades, right, on a quarterly basis. Now that impact will mean that the corresponding quarter in the subsequent year could actually benefit from that low base. It's like you're at 100 levels, and then you drop to 50, and then the subsequent year you move to 60. You will see that the impact of moving from 50 to 60 will be kind of significant. And that was what we saw right now. And, from our own analysis, if the economy had grown by, say, 7%, not of 7% as a Q2, it would have been a good, improvement on what we had in 2020. But if you are to put it in perspective relative to what we had in 2020, it will mean that the economy even dipped further, despite having a 5.01% growth. One of the economy, I say it always, one of the, the woes of, economic analysis is mathematics, because you're just looking at numbers, right? So I had some level of growth in Q2 2020, and I'm now comparing it to the level of growth I am having in Q2 2021.
Yes. Now,
forgetting that, I'm looking at 2 corresponding quarters. By the way, between Q2 2021 and Q3 2021, Q2 2022, I mean, to Q3 2020 and then Q4 2020,
okay,
down to Q1 2021, we have seen some, pattern, right? So from Q2, which was the lowest we saw, we've seen improvement up until Q1 2021. When we saw, so when I say improvement, I mean in terms of the constant value. Your GDP is measured from the real value of economic activities when it has been discounted for inflation. That's what we call GDP at constant value. So it's that constant value that's producing this level of growth that we are seeing. So as a Q1, the level of growth you recorded in terms of constant nature of the value, was even better than what we saw in Q2. However, because the low base effect of the corresponding quarter of Q2 2021, we saw significant jump. So it now looked like Q2 GDP figure was actually better than Q1 2021. But that's not the case in real terms. In real terms, we've seen a decline between Q1 and Q2. That is, Q1 GDP figure was better than Q2 GDP figure. However, because we are measuring growth on a year-on-year basis, and then we had a very low base in Q2 2020, you are now seeing that Q2 2021 is now showing 5.01. Now, the caution for us will be, are we going to see these continuous increases? That depends on what's going on. I mean, you read out in your own data, right? We saw improvement in GDP, but you're seeing the level of unemployment still under the waters. And that's the real economic activities going on. So if your people are losing jobs and inflation is rising, whatever growth you then see in the economy, you have to be able to dissect it for impact, or for, put it in context, more or less, to say, okay, why are you seeing this level of growth? And purely explain, it was basically mathematics. And if you dissect and you look at what contributed to that 5.01%, you would see, in actual sense, that the oil GDP, which seems sometimes to be the driver of the economy, contracted by 13%.
Exactly. I'm going there because even our production, we're doing about 1.6 million, I think, barrels per day.
Absolutely.
Instead of about a 1.7 or so I was supposed to be. And that's not even up to what we should do.
Absolutely.
So I wanted to take that question as you're going to answer vis-a-vis performance of the non-oil and the oil sector.
So, if you look at it, right, the non-oil sector in the real sense of it should be, should I say, the major driver of the economy in the real sense, and it still drives the economy, because the Q2 number you're seeing was actually contributed by, non-oil sector largely, which grew about 7%. So non-oil sector accounts for about 90% of the overall GDP. Meanwhile, the oil GDP is about 10%. I mean, again, there's an irony to that, by the way, because when you are now analyzing, Nigeria's external trade statistics, you will see that this same oil sector that accounts for just 10% of your economy accounts for about 80% of your exports. And that's where the misnomer is when we are looking at the pricing I mean, when you're looking at the structure of the Nigerian economy. But, if you drop that aside, when you look at that number, you will see that oil GDP contracted by 13%, again, because production numbers have not been encouraging. The fact that oil prices increased between Q2 2020 and Q2 2021, it won't impact on the real growth, because what we are measuring is real economic activities, if you like, is the output that we are concerned about. So if we're, around 2 million barrels per day last year, and now we're talking about 1.6, 1.7 million barrels, clearly there has been a decline in terms of economic activities. But non-oil came to the rescue, and that's why we saw that non-oil grew by 7%, which accounts for about 90%, 89 to 90% of the entire GDP structure of the country. Now, the point then we should begin to make is that for how long are we going to be dependent on oil, for the survival of this economy? Several discussions have been had as to what government can do, to really, like we will say, the economy is diversified, right? The economy is diversified because when you look at it, we have different sectors contributing, but are the sectors operating at their optimum capacities? Okay. Clearly not. Okay. Because when you look at manufacturing, for example, we've dissected it a long time in this studio. When you look at that non-oil GDP, a significant part of it is services. From telecoms to real estate to all the services, financial services, put together in the economy. They are accounting for a significant chunk of our economy, but we have abandoned a phase of growth. In classical economic study, we will always talk about phases of growth, right? People will move from primary stage to secondary to, tertiary. Sure. Services looks like a tertiary stage of production, but we have moved from more of primary to tertiary, and that secondary phase where you should have a lot of production going on in our economy, we are not seeing that happening. Again, power is an issue. If manufacturing sector will grow. Issues around our foreign exchange is also an issue, because most of the inputs that will come into the country will be through foreign exchange. And you cannot blame the central bank for this. Central bank is only managing the scarce resources that we have in terms of foreign exchange earnings. So what can we do to begin to, build a sustainable economy that will stand the test of time and will not just grow on the basis of base effect factors alone? Now, it then means that we need to look inward. You've talked about this a long time also, because of the policies of governments that needs to be addressed to make our business environment competitive for capital flows. Because we actually need capital flows to drive activities within the manufacturing sector. If someone is going to invest in our economy, say power, for example, if there is no, enabling policies that will, convince the person that there is money to be made, investors will not bring, they are not charity, right? They won't bring their money when they know that there are no monies to be made. But when they see the opportunities and they are clear cut, they will invest. If you're able to drive power sector, and you solve the power problem in Nigeria, it will lead to a lot of positive, solution on other sectors of the economy, manufacturing as we speak. So these are critical issues that the government needs to begin to, consider as we look forward.
This, according to the report, this also reflects a return to normal economic activities that's following the COVID-19 lockdowns and all of this. It's a two-in-one question. For me, are we really back to pre-COVID times? Looking at what's happening with the third wave of COVID-19, I don't think it's all clear as we move on. What's your reaction to that with regards to economic activities, even globally?
Well, globally, yes. The issues about the variants, the Delta variants of the COVID-19.
More variant. Trust me.
So the variants of the virus, it's because it's seen that the virus can mutate, and then begin to find other ways of expression, which is why we are talking about all of these variants. But again, there are ways, apart from increasing the rate of vaccination, in countries like US, you're hearing things like boosting, those who have taken the vaccination, they need to take some, boosters, some immune boosters that will, further help them. Now, while all of those are going on, the good thing is that we are not likely to go back to the 2020 era where there is permanent lockdown, you know, and across board. I think economists are beginning to understand that, you know, there are ways to, you know, begin to address all of this. And even as we speak, the economy is gradually returning, and if not to full, you know, normalcy. And you're seeing, you know, innovation taking over, you know, in various countries of the world, including Nigeria, where companies, you know, are still, you know, working from home, right? And they would attest to the fact that they're even more efficient. You know, it's not all the sectors that can work from home. Anyways, there are some sectors that still need to be there physically, but quite a number of, you know, sectors are working from home. And this is one of the strategy, or should I say, one of the innovation of COVID-19, you know, which COVID-19, you know, forcefully brought upon us. Now, all of those will continue, while, you know, I think governments and, you know, economies will continue to be resilient, you know, and looking for ways to just, you know, circumnavigate all of the challenges that we're facing right now. As to whether we are fully back, you know, we cannot say that, even globally, you know, because if you look at what's going on, you know, there's still a lot of monetary policy stimulus that are being injected into the economy just to boost economic activities. And as to when those will be rolled back, definitely it's not in 2021, you know, perhaps the later part of 2022. And in Nigeria, you know, we are gradually also seeing return to normalcy. The issues we are facing right now, you know, they stem from slow growth figures that we are, you know, recording, again, because a lot of people lost jobs and some of them are not back yet. And the fact that we are seeing slow activities on the oil sector, which is also impacting on government's abilities to, you know, do most spending. But by and large, we think that the economy will, you know, will get out of the woods, definitely. You know, as you can see, this is the third consecutive growth that we will record in the year. The fear now is that we shouldn't slip back into the negative territory. Because, I mean, there's a certain level that we have to get to. For instance, if you look at Q3 GDP from a quarter-on-quarter basis, you know, on a quarter-on-quarter basis, I think it was last year we recorded about 18 trillion naira, I mean, in real GDP terms. So if the economy must grow this quarter, you know, on a quarter-on-quarter basis, we should not record any growth less than, you know, 5 to 7%. On a quarter-on-quarter basis. Otherwise, we may not be able to sustain a positive level of growth in Q3. You know, but if you take all of those risks out, you know, the inflation risk is definitely dissipating right now. You know, are
we going to follow that trend?
Yeah, the trend should continue on a base effect also, because last year we had, you know, high base effect, and this year we are seeing that is moderating. So our forecast is that between 14 to 15% settlement, you know, by the end of the year. But as we see, its current level of 17.3% will continually decelerate up until December. You know, what we fear the most for new pressure points for inflation will be pump price of petrol, you know, and the electricity tariff. Yes, those two.
If that happens.
Those two elephants.
If that happens.
You know, we have not successfully addressed those two issues.
What do you think will happen if that happens?
Well, if that happens, then we see new pressure points, because don't forget, energy accounts for close to about 15% of the consumer price index. And it's very major. There is a historical trend to suggest that anytime there is an increase in electricity tariff or pump price of petrol, the impact on inflation can be as high as 2 to 3%. If not 4% in some instances, you know. So what it means is that depending on the magnitude of increase that we'll see, if we move towards a market reflective, you know, tariff for electricity and market reflective pump price of petrol, you know, I think
they are both market reflective, indeed.
Exactly. So if they are both market reflective, then we'll begin to see another pressure point in terms of inflation. Never minding the fact that we still have issues of insecurity affecting, you know, farm produce. Because the greatest source of pressure the consumer price index is witnessing now is food inflation, you know, which accounts for about
above 20%, I mean.
Well, you know, food inflation is above 20%, yes, and it's accounting for about 51% or thereabout of the CPI. So for as long as we have insecurity, farmers can't go to farm, and supply is constrained, then, you know, equilibrating factors of demand and supply will then mean that prices will continue to go higher. and that is your inflation, right? So if we must address that issue, insecurity issues must still be addressed. We can't stop talking about it.
You've talked about the ease of doing business and making it possible to attract more investment into the country. We also see our reserves. That last week we reported about $500 million adding to our reserves. We also talked about the special drawing rights and all that SDR, we expect. All of this put together, what do you think? What are these deliberate policies or deliberate moves that should be made so that we can be sure, maybe, should we say in the short term, what we should expect with regards to growth of our economy? Because everyone is just going around 5% growth. But breaking it down now, we understand that in reality, we still have a lot of work to do.
Absolutely. So again, when you look at the reserves, I think it was on the 23rd or so of August that the central bank was able to get credited with the special drawing rights, the SDR, and that is what has boosted our reserves to the current level, which is I think about $34.1 billion, right? And we'll continue to see this impact, because don't forget, the reserves itself is a 30-day moving average, right? So, since the last time it was credited, you expect that from 23rd of August, we may see that impact up until 22nd or 21st of September, after which new realities may then set in, right? But again, there is another positive in the sense that the DMO or the Ministry of Finance has announced that by October they'll be approaching the Eurobonds market for new issuance. I think that may account for about $4 to $5 billion that they will be seeking to raise. That again will be another booster for the reserves. Now, when that happens, it means that the central bank now has a bit more capacity to continue to support the local currency. Right now, the impact of the SDR credit may not be seen largely on the reserves, on the exchange rate itself, because central bank, of course, has more power to now intervene at the official window. But what then happens at the parallel market? So, but when we see this inflow from the commercial Eurobonds issuance, then we can now see much more capacity from the central bank to continue to defend the currency. But as it is right now, the reality of our exchange rate valuation suggests that we are not going to see any levels lower than $500 dollars at the parallel market, anytime soon. Right now we are comfortably above, I think, around 520. Thinking that it will go below 500, we're not seeing that happening anytime soon.
But wrapping up, we actually discussed this, and many argue that we should let also the policy of the demand and supply take charge of the forex market. Do you think that can also work in this case?
Yes, it can work. It can work, but the central bank, in its own wisdom, has decided to be, so what the policy they adopt now is what they call a managed floating, exchange rate, where the central bank, to a very large extent, try to control the demand, in order to, given the level of supply that is available. And that's why you see that disparity between parallel market and, the official window. I am an advocate of the market anytime, any day, because anytime you don't go the way of the market, that's when you see inefficiencies in the system. But as we speak, the central bank will argue that, keeping a managed floating system, helps to protect the poor. Unfortunately, it's just that it's only at the official window. For instance, if you look at activities within the real estate sector, for example, you will see that most items that are imported into the country, they trail the parallel market rate and not necessarily the official window. So most times when we claim to protect the poor, the poor still get to be, transacting at the parallel market because of all of the restrictions that we have in terms of demand, sources. But like I said, the central bank knows, in his own wisdom, that floating it at this time may not even be the best, because you have to be, to be able to ensure that there's sufficient supply to defend the currency in the event that, there is a run, if I would say, on the naira.
Intelligent conversation always with you, Mr. Robert Omotunde. He's the Chief Investment Officer at AfriInvest West Africa. Thank you very much for stopping by, spending your afternoon with us on Business Nigeria. We really appreciate this.